Hey everybody, welcome back to another dividend stock valuation video. Microsoft, ticker MSFT, is at its 52-week low, but is it a buy? In this video, I will attempt to answer that very question. This is the Dividend Growth Income channel. I'm Nick. Thanks for joining us. We love dividends and particularly dividend growth stocks. We worked hard to bring you this analysis of Microsoft, but please remember that I am not a financial advisor or guru, just a guy who loves dividend investing. Nothing in this video should be taken as financial advice. Please do your own due diligence before buying any stocks we discuss on the channel. So, Microsoft Corporation is an American multinational technology corporation which produces computer software, consumer electronics, personal computers, and related services. They're headquartered in Redmond, Washington, and they are best known for software products such as Windows software, Microsoft Office, Xbox video game consoles, and the Microsoft Surface lineup of touchscreen personal computers. The company was founded by Bill Gates and Paul Allen on April 4th, 1975, and they rose to prominence with their MS-DOS operating system in the mid-80s. Following that, they released Microsoft Windows, and things took off from there. They've also made numerous acquisitions over the years, such as LinkedIn and Skype being notable examples. Let's look at what Microsoft has been doing in the market. This is a 1.7 trillion market cap, and this is the second largest company in the world just behind Apple. Microsoft takes up almost 6% of the S&P's market value, so its movement greatly affects the broader market. Like most other companies, its share price has taken a tumble over the course of 2022. Year to date, it is down 31.72%. But wow, has this been a fantastic long-term hold with market-beating returns. Over the last 5 years, Microsoft is up almost 195%. And over the last 10 years, Microsoft is up nearly 700%. Of course, this begs the question, how much larger can Microsoft get? Can it continue to grow at this rate? And check out this revenue growth. Year over year, that revenue is climbing. In 2013, they brought in $77.8 billion in revenue with a gross profit of $57.7 billion. And in fiscal year 2022, they brought in $198 billion in revenue with $135.6 billion in gross profits. That is insane. Microsoft is basically printing money at this rate. And they have the cash to cover their debt today right now. They are sitting on $104.75 billion in cash. And they have $76.4 billion in liabilities. Beautiful. Microsoft also provides value to shareholders via its buyback program. Shares outstanding have been declining every year for the last 10 years. All of this growth has brought its valuation up over the years, and that valuation has been one reason investors might hold off on Microsoft because everything else looks so freaking great. However, with the recent drop in prices, while the stock is not cheap, by almost every metric it is well below 5-year averages. Its forward PE of 22.7 is about 20% lower than its 5-year average of 27.5. I do think this could come down more. Compared to the technology sector, Microsoft is understandably trading at a premium. The sector average PE is 14.8. Microsoft is definitely not your average technology company. The dividend yield is nothing to get excited about, but the yield is low because the price of the stock has risen at far beyond its dividend growth. The current yield is 1.19%. And this is right in line with its 5-year average. Note that 5 years ago, this yield was well over 2%. And 10 years ago, Microsoft was flirting with a 3% yield. Microsoft is a solid dividend stock with an excellent track record of dividend growth. As we have seen, holding Microsoft for a 10-year period has been amazing. But let's look at the dividend you'd be receiving based on your initial cost 10 years ago. This is the concept of yield on cost. Now, if you'd purchased Microsoft shares in October of 2012, you would have a yield on cost of 9.22% of your initial investment. And this is why we as dividend growth investors who have time on their side can benefit from focusing on quality dividend growth stocks rather than seeking higher current yield. Microsoft makes its quarterly dividend payment of 68 cents on the months of March, June, September, and December for a total annual payout of $2.72 per share. The dividend only takes up 27% of forward earnings and 29% of forward free cash flow. No concerns here. Simply Safe Dividends provides a safety score of 99, and Microsoft Dividends is as safe as a dividend that exists on the market. Plenty of room for future growth. Dividend growth, while unable to keep up with its fast rising share price, has been quite excellent. The 5-year average annual dividend growth rate is 10%. And the latest dividend hike was announced on September 20th, 2022 for a 9.7% increase. Wall Street loves this stock, giving it a strong buy rating of 4.6 out of 5. Covered by 50 analysts, 32 rated a strong buy, 16 a buy, and 2 a hold. So Microsoft is a great stock to own for dividend investors who don't rely on current income and are looking for the total growth package. It's at a 52-week low, but is it a buy today? Let's find out. Okay, so what I do is I use the average of 6 different valuation models, as no one valuation model is perfect. I take the average of those 6 to determine a fair value. Then I can apply a margin of safety to determine a buy price. If you've been following my videos, you may recognize this spreadsheet here. And what I do is I'll enter the ticker. It'll give me my current share price of $228.56. The annual dividend of $2.72 gives us the 1.19% yield. And I entered in the forward PE of 22.7 and the forward earnings per share of 10.13. The first valuation model is Graham's revised valuation. I had to give an estimated expected growth rate, and I checked out what the analysts at Yahoo Finance say, and they are projecting a 15% growth rate over the next 5 years. That is about in line with what they typically do. And the current yield for AAA bonds is 4.59%. This provides a fair value of $213.63, so the current price is a bit above for this valuation. Next, let's look at the dividend discount model valuation. This is useful for dividend investors like us. This is a lower yield stock with higher dividend growth. Historically, they've grown at a 10% rate, so I'm going to go with a 7.5% rate going forward to leave room for it to slow down some. And I'll assign a discount rate of 9%. This provides me a fair value of $194.93, and this is about what I expected based on the dividend valuation, as it's a lower yielding stock. The third, I like to consider the discounted cash flow valuation. We take the current free cash flow and project a growth rate for the next 5 years. What I'm using is 15% as from before, and with a perpetual growth rate of 3%. This takes the sum of all future free cash flow, discounts it to the present value. And with that, we divide by shares outstanding, which is at 7.54 billion, and a 9% discount rate, and this gives us an estimated fair value of $244.78. The next valuation is done by taking the historical 5-year yield and calculating what the share price is at that yield. As the yield and the historical 5-year yield are only a few basis points apart, there's very little change here, fair value of $236.52. Fifth, we consider what the price would be if we calculated based off its historical 5-year price to earnings. And that's 27.5 times earnings. Microsoft would be trading at $278.58. Lastly, I add up the analyst's average price target, and at the time of publishing, that was $329.07. That's quite a bump, but that is still less than its current 52-week high of $359.67. Take that for what it's worth. Now, bringing that all together, I estimate the fair value of Microsoft to be $249.59. This is 9.2% upside from the current price. Now, most of the time we do want a margin of safety before we buy. We have to consider the stock is down 30% year to date. Also, lows during the COVID crash were around $135, so dipping below 200 is not out of the realm of possibilities. We have no idea what's going to happen. Not 10% margin of safety, the buy price is just about there. It's $224.65. One more red day, we'd be right there. At a 20% margin of safety, the buy price is right below $200. Another 12% drop would bring Microsoft to this level. And again, I think that is very possible in the next month or two. Now, if you want to be more conservative and go with a 30% margin of safety, the buy price is around $175. Now, full disclosure, I am long Microsoft. It's one I was buying up in the COVID crash, and I managed to hold it through my divorce that year, which is where I got my ass handed to me in family court. My average cost is $169, so I'm still up, even though it was up way earlier in the year. Now, I haven't added since the year 2020 in the summer, but with the recent drop, adding a couple shares in the next month is a possibility, especially if we get below $200. Microsoft is an awesome company, and for me it's a no-brainer long-term buy and hold. I am a proud shareholder. Now, please don't take my advice on this and do your own due diligence. Remember, my calculations could be wrong, an estimate could be off. Guys, I hope you found this helpful. If you did, please smash that like button. Also, check me out on Twitter at DivGrowthIncome. I love connecting with like-minded investors. Thanks for watching. Until next time, guys, keep investing.